Welcome to the Doctors Making a Difference podcast, where we help physicians to be empowered with the tools they need to be successful in medicine, in finance, and in life. Join us as we highlight doctors and other professionals around the world who are making a difference. Welcome back to Doctors Making a Difference. I'm Dr. Peter Crane. This show has always been about physicians who want their careers to mean something beyond the RVUs, beyond the normal day-to-day practice of medicine. Leaders, change makers, people building something purpose-driven. And here's one of the challenging truths. It's hard to do mission-driven work when you're financially trapped. Money isn't really the point, but the lack of it will quietly dictate every decision you make. I think that's so true. We have to be able to be on the path toward financial independence, or you really are stuck with all the decisions that you've made in the past, and it's really hard to move forward. So today, I'm stepping a little outside of the usual lane. I'm doing an interview with Jeff Sekinger, the founder of NURP, NURP, an algorithmic trading company. Jeff's built 3 companies in finance: 0%, which is in financial education; Orca Capital, a digital asset hedge fund for accredited investors; and NURP, which licenses that strategy toward individuals. And I told my team I'd only do this if I could ask the hard questions. So Jeff, fair warning, he told me I could ask him hard questions, so we'll give it a try. And just a quick disclosure before we start, and I really mean this is a sponsored episode. NURP is a partner of the show, but a sponsorship doesn't necessarily buy a soft interview. NURP is a software and financial education company, not your financial advisor. And nothing in this conversation is financial advice. It's the start of your due diligence, not a recommendation. Trading carries real risk, including the risk of loss. So, Jeff, welcome to Doctors Making a Difference.
Thank you, Peter. Excited to be here.
Yeah, glad you're here. Tell us a little bit about it. Again, Jeff, you've built 3 financial companies: 0%, Orca Capital, and NURP, which is quite an accomplishment. But tell me a little bit about kind of what's your objective? What's the through line? What problem are you actually solving when you built all these platforms? I want to hear a little bit more. Unpack that for us.
Yeah, so 0% actually started from my own financial journey and my own financial struggles. When I left college, it was primarily a credit education company. We helped entrepreneurs really optimize their credit and get funding for their businesses and scale their businesses. So that was my first major venture. We had a few thousand clients through that company. And not too long after I left JPMorgan in the corporate world, I was in the largest bank inside the United States in asset management and always loved just money management and investing in general. Actually, I've been investing from a very early age, thanks to my dad. He created a little competition against my sisters and I to see, we would pick a stock, and whoever had the highest return at the end of the year with a couple $100, we would get a little $100 or something small.
That's awesome. That got me. Dad's brilliant.
Yeah, it was a smart move because we picked companies that we actually liked and enjoyed using, whether it be, I think my sister one year picked Jones Soda, and I picked like an electronics store. And I think we each had $1,000 to invest. That was my dad's money. And then we would win $50 or $100, whoever had the highest return throughout the year. So that got me thinking about investing from an early age. And then when I left JPMorgan, I started my first hedge fund, which was Orca Capital. Had that since 2019. And like you mentioned, it's just for accredited investors. Primarily, it gives them exposure to alternatives in the digital asset industry. And we also have a quant fund that deploys a long short strategy that trades different currencies and commodities. That vehicle is just for accredited and something called QEPs, which are 5 million net worth and above. And what I realized was there's a lot of people that are in this kind of middle department of wealth where maybe they're worth 250,000 or $1 million or $2 million, but they don't quite reach the state where they're like an ECP or a QEP, which is like a $5 and $10 million net worth. And when you get to that point, you start to get access to a lot of different deals. And oftentimes you're working with a bank or Goldman Sachs, Morgan Stanley, JPMorgan, and they're even presenting opportunities that you would not get from just being a regular, like somewhat high net worth retail investor. So I was thinking of a way, how could we do something in alternatives that gives people exposure to a different type of an asset class that helps them diversify in their portfolio and is aligned with something called the modern portfolio theory And inside the modern portfolio theory is something called the efficient frontier, which really means that you've got an efficient allocation to different assets that are uncorrelated, that all operate slightly differently. And with the correct allocation, you can have the highest expected return and relative to the risk that you're taking. And that's one big piece of the higher net worth portfolio is people have exposure to oftentimes equities and bonds and real estate and all the typical things. But inside of the efficient frontier is the alternatives asset class, which some people invest into venture capital. Maybe they hold some different types of precious metals. Maybe they've got a card collection or art or things like that, where it can produce a higher return, but it's often uncorrelated to other investments. So just with my education and professional experience in the corporate world and also running a hedge fund, we launched NURP about just like 4.5 years ago now. We've had 3,500 clients, so it's grown really quickly.
Wow.
And a lot of them are medical professionals. We've just found that niche really enjoys our products. So what we do is we take a successful trading strategy, we build that into a software, and then you license that software in your own brokerage account. So you keep your own capital in your brokerage account. You can deposit and withdraw at any given time, but you can jump into a successful strategy that's actually back tested and has something called positive expectancy, which means that it makes money. Now, it doesn't guarantee it always makes money into the future, but at least a lot of people, I've even had a talk to a few other doctors that have tried to trade for themselves. And I can tell you, it's not a very easy thing to do. So this definitely speeds up that learning curve and allows people to have a different type of exposure in their portfolio.
No, great answer. Thank you. And I'm no financial expert. I'd like to dabble in it and think that I know stuff, but those who work in the financial industry see it from the inside. And you specifically had that experience. You worked at JPMorgan, huge bank. You saw how assets are managed in these really large structural ways. And I guess one of the questions as you break down all these different investment instruments, you described a second ago, seeing things where people have $5 or $10 million net worth, they can invest in things that wouldn't be available to other folks. And I guess what I want to know is, what did you see that experience at JP Morgan that made you want to do something that was more specific for individual investors? Because there's a lot of these big terms and we throw around in medics and a lot of acronyms and a lot of things that have meaning. And medicine and finance have that same feature. There's lots of verbiage and terms that are used that way. And I believe it's easy for people to get lost in some of the details unless they have a finance background. But so just walk us through what made you decide to leave JP Morgan and start something that would be worthwhile for individual investors? And what are some of the holes that those folks like me don't necessarily see?
Yeah, the primary reason I left is because I studied something called the values determination. I took a values determination test through a guy named John DeMartini, and I found what my 3 highest values were. And they were to have freedom, options, and choices, see impact on people, and have uncapped earning potential. And none of those things I was getting in the corporate world. So I knew that I wanted to always stay in finance. I just enjoyed investing in general. So I knew that the corporate world was not going to give me those 3 things. So I wanted to start my own venture. I wanted something more exciting. And the big thing that I saw in the corporate world is like people have access to different types of investment products when you get to a certain level of wealth where there's downside protection. Let's say that you've done really well in this AI trade, your portfolio is way up, the S&P is at all-time highs. If you have a significant portfolio, I would say at least 5 million. Oftentimes, again, it's 10 million. If you're in the ultra high net worth class with Goldman Sachs, it's usually 30 million. So those different tiers can give you access to products where they can limit your downside. For example, you could have a 10% downside or even sometimes a 0% downside, but your upside is capped. So what that means is if the S&P does 15%, let's say your capped upside is 12%, you would just be capped at 12% that year. But if the S&P goes down by 40% next year, you're capped at that 0% loss, or you're capped at whatever, a 10% loss. So there's special products that they have engineered certain types of derivative products, which are like options or futures contracts, where they actually hedge the overall index or asset that you're investing in. And just the typical person doesn't have that ability for those types of products. And then you also get huge deal flow through these desks at these banks that they've got all different types of venture capital funds, private credit funds, private equity. And if you look at private equity returns, Oftentimes they pretty far outpace just the average S&P 500 return. And some of these highly professional venture capital funds as well have pretty insane compounded annual growth rates as well. So I just saw a lot of things that the higher net worth person gets access to that like a busy medical professional, even if they are at that level, they might not even have the time to even talk to their bank and be thinking about those different products. So they're just busy growing their businesses. So I just found a big gap that's okay. Yeah, you can easily invest in an index. I was a private client advisor and be in the private bank and be a wealth manager. That's what I thought my whole career was going to be. And it's a great path, but it just wasn't for me. So I'm like, how can I make a difference and actually do something that is different, that's an alternative, but still give the access to the everyday higher net worth professional, but without the hurdles of you have to meet this accreditation standard. You have to be worth $10 million. With our model, you're just licensing the technology. You understand how it works because of our education that we provide when you get onboarded. And then you have the ability to take money out of the account at any given time and change a few settings. So it gives you certain types of access to products that you would never get yourself. And if you look at the most successful hedge fund of all time, you probably think of like a guy, Warren Buffett, right? He's a very well-known asset manager, right? He compounded probably 20 to 30% a year on average. He had some down years, but over a long period of time, he compounded like 20 to 30%. And everyone thinks that he's the most successful of all time. It's actually a guy named Jim Simons, which ran the Medallion Fund. There's a book on him called The Man Who Solved the Market. And what he did is he ran trading algorithms in a fund and compounded at 66% a year for 30 years. And they got to the point where they had well over $100 billion under management, and they reached essentially capacity constraints, and they kicked out all their investors, and now they're a proprietary trading firm. Jim passed away, I think, like a year and a half ago. But when I'm looking at doing something, I always want to look at who are the most successful people in the world that do that thing. And I want to understand what they're doing and try to mimic it as close as possible. So yeah, that was a big eye opener when I found, okay, it's not a real estate investor. It's not a value investor like Warren Buffett. It's a guy that built technology, trading systems, quantitative trading inside of a fund and grew that at the fastest rate that the world has ever seen.
I want to reflect back on something you said. One of the challenges when you go through medical training, you know this because you've worked with doctors, you get to be somewhere between 32 to 35 years old, and you've spent the previous 2 decades, 15 years, somewhere like that, training, and you're so busy and you've got student loads up to your eyeballs, and it feels really kind of overwhelming. And in those first 10 years, I think it's just trying to figure out how to survive and keep your head above water and pay off your loans. And I don't think doctors necessarily get a lot of formal financial education unless they had some sort of finance training in their undergrad or something like that. But I do think when you talk about this, one of the challenges is timing, or the time. Which busy medical professional is going to take the time to be able to really understand this kind of stuff and be able to say, I'm capable of doing more, because it feels like you're just hanging on by the skin of your teeth. And so I do think it's interesting that you built a platform where people have access to some of these funds that are maybe not traditionally accessible to the regular folks that don't have the super duper high net worth. And you mentioned that NURP is really built on this idea that we're preserving capital and giving investors autonomy. Tell us a little bit more about that.
Yeah. So like I was mentioning, the strategy, it enters, exits, and manages every trade. Like I talked to another doctor last week, and he was like, look, I joined this thing called a signals program where someone was giving away like stock trading plans where they say, hey, I'm going to buy NVIDIA at this price and sell it at this price. And the doctor was trying to follow along. And he's like, okay, let me open up my brokerage account. Let me put the limit order in. Okay, once it fills, I'm going to make sure to take profits in and then stop losses in. And then he's trying to manage the trade. And he's like, it's just almost impossible to do because he's sleeping, eating, drinking, going out with friends, family. He's at work a lot of the time. It's almost impossible for him to execute that. And that's the majority of the trading education community's products out there, is they just will give you a newsletter or they'll put you in a Telegram chat and you need to try to follow those signals. And it's almost, like I said, nearly impossible. I think the recent statistic is 96 to 99% of day traders, when they trade for multiple years, end up unprofitable, losing money. So it's not an easy thing to do. And what we've done is we've built a strategy, specifically the one we're talking about a little bit tonight, that we're going to give you an account to just test for yourself over the next 90 days. We built a strategy that trades gold, and it looks for specific setups, and it will just sit there and wait until an opportunity. So the cash in the account sits in cash. It's not invested in gold. It sits in cash, waits for a specific opportunity, and only enters when all of these programs that we've inputted into the software meet at one point in time. And then it will execute the trade and manage that trade. And what that looks like from a management standpoint is just entering the trade. It has a predefined stop loss on every trade. So if it's wrong, it just gets out on a smaller loss. And then if it's right and it starts to go into profit, it moves that stop loss up automatically and just follows the trade and sees essentially how much it can profit out of any given trade. So we've taken that software. The cool thing is we can buy the data for gold. We bought the data over the last 15 years, tick by tick. We bought 100% tick data, which just means that it's about as accurate of data as you can get on gold. And we can back test that strategy over the last 15 years and say, okay, if we were running this in an account, what likely would have happened if we were running that in the account? And then it shoots, we run the back test, it runs all the analytics. We can see the Sharpe ratio, Kalmar ratio, profit factor, all these things that you probably don't understand. But what matters is it came out with something called a positive expectancy, which means that it was profitable over the long haul. It does have some losing months over those periods of time. And even our live track record of 16 months has some losing months. But what matters is overall, the growth trend is up and to the right, and it's positive. And so far, it has been on live and in all of our back testing.
I'm excited to try it as part of this. Like you said, I'm going to have access to basically a base set of money and try it with this and see how it goes. So one of the features on this that is mentioned is the investor autonomy. Describe that a little bit. What does that mean? So if I took some money of my own and put it into NURP and I wanted to say, okay, I'm going to invest it in these various assets and not trade until the conditions are just right, how do I maintain that autonomy? Because it's, like you say, it's busy. I don't understand all the financial terms. I don't have the years of working at JPMorgan like you do. So describe what that means.
Yeah. So instead of you manually placing all those trades, the software is doing, I would say, at least 99% of the work for you. What you're doing is you're picking a brokerage, you're depositing whatever amount of money. It has to be at least $10,000. That's the minimum for the strategy to function on. But we've got people that are investing $1 million or anywhere from $10,000 to $1 million in an account. And then you'll go to our private dashboard, a licensing portal. You'll connect your brokerage account to that portal. And then you hit license the strategy, which this strategy is called Midas. So you can just go into our portal and turn the strategy on. And now you're licensing that software into your brokerage account. And then you can monitor what it is doing on a minute basis if you want. It's all live data. But you can pull up like a chart, which is just a terminal where you can see the price of gold. And then you can see every single time the algorithm's entering. So you can see each arrow, which represents a buy or a sell order. And then you can see a dotted line on where it actually exits that order. So you're just watching the strategy in front of your eyes execute in your own account. And then you can pull profit at any time. You can pull all the money you've put in at any time. It's all up to your relationship with the brokerage. And then you could set things like an equity protection. So if you don't want to lose more than 10%, you could say, you know what, I'm going to set an equity protection at 10%. You can do this right inside of our portal. And if the strategy ever breaches a 10% loss, it'll just close all the trades and stop trading and send you an alert via email so that what happened, and it won't turn back on until you go back into the portal and turn it on. So yes, you do need to turn the strategy on. You do need to deposit money into the brokerage. But as far as like you manually looking at a chart and waiting for a setup to go in front of your eyes and then you entering the trade and managing it, you don't need to do that hard grunt work, which the hardest thing is finding a strategy that has positive expectancy, like I've said. And then ultimately the time that it takes to just sit there and just be patient and wait. That's one of the hardest things. Most people overtrade, and that's why they tend to lose money. So this is removing the emotion. It's removing all of the errors that you make because you're so annoyed because the setup isn't showing in front of your eyes. It's removing the, oh, I watched a YouTube video and I heard about this head and shoulders pattern. And now let me go trade the head and shoulders pattern. And In fact, maybe it worked on Bitcoin, but it doesn't work on gold. It doesn't work on the S&P 500. There was some other macro event that threw it off, or just flat out that strategy just does not work on that asset. So people don't think through that before they start to trade. And that's why they tend to lose money. So a lot of the errors that occur from trading, we've taken out because the software does the majority of the work.
That makes sense, because I guess one of the other questions is most people, when you ask, they have a 401k, or they maybe have a mutual fund that's invested in an index fund or a real estate investment trust or something that's relatively easy to simple to understand. And the other point that, like you said, is if for people that are day trading and trying to follow the best asset class, a very large percentage of them come out without gaining money over the long term. And so from what I understand, NURP uses an algorithm that basically tries to remove some of those errors and human emotion from that, so you're more likely to actually come out positive. But I guess that's one of the questions I want to ask. Many people have their entire net worth tied up in their practice or their 401k. Where's the place where this belongs, where someone says, I want to invest some of my money in an algorithm-based trading like NURP, and kind of compare and contrast? Because I don't know that everybody should put all their eggs in one basket either way, but kind of teach us a little bit about that.
Yeah, exactly. You should really, there's few examples in the history where it has gone really well for people that have put all their eggs into one basket. You could point to Elon Musk and say he's the first trillionaire. Yes, but because he took the money that he got from business and put it into the next business and it happened to do well. And he may be an alien. I'm not sure he's even human. But if you hear about that story and you're like, oh, I should just go do that. But in reality, there's probably at least 1,000 people that it did not go well for, that you don't hear about, that tried to do what he did, but ended up in a pretty rough spot. So I totally agree with you. It's generally not the best idea unless you are a professional investor and you're really in control of your investments and you're highly educated on it. But even then, a lot of people still will diversify at least across 10 different assets if they're investing directly for themselves. But yeah, so I think the main thing is what we found the most success with is higher net worth individuals that already have a portfolio. So they've got maybe an index, they've got a business, they've got some real estate, maybe they've got a little bit of gold, and then they're partitioning off a piece. And generally it's a wide range, but I would say between 1% and 20% of a portfolio. I would never start with 20% because you don't understand it right away and you need to get your feet wet. So I like to see people start smaller. And then once they understand it and they're comfortable and they see how it trades and what the risks are, then they start to scale up the amount of capital that they're putting into the account. So generally, yeah, I would say between 1 and 20%, again, what I mentioned earlier, which is modern portfolio theory and the efficient frontier, which anyone could go look up. You can go Google those terms and see what it means. But really, the most efficient portfolio has some of those safer investments. The S&P 500, 10% a year. It's got bonds, maybe it produces 4% in income. Then you've got some real estate and it appreciates 12% a year. Right? So you got this mix and all those assets fluctuate at different times. So when stocks are going way down, your bonds are supposed to go up because generally they're inversely correlated. Real estate can sometimes hold a bit stronger than maybe the equity market. So all those things help smooth out the volatility of the portfolio. But what most people don't do is they don't have this last piece, which is the smaller piece, which gives you the asymmetric upside. So yes, they're generally higher risk, but they generally are more uncorrelated to everything else you have in your portfolio, and they have the potential to produce a much higher return. And that's why you're allocating a smaller portion of your portfolio, because you don't want to put all your eggs into a high risk basket. You want a smaller portion of your portfolio in there, because if it does pay off, a 2% allocation could become 15 or 20% of your portfolio, which is a pretty dramatic impact that you could have. And that's why people will invest, like the higher net worth, more educated person, they do partition off 5% of their portfolio and put it into venture capital. Put it into a quant fund or an algorithmic trading strategy. Put it into maybe some early stage precious metals miners that are like a bit higher risk, but they could really pay off. That's generally what our product fits under, is the more like asymmetric upside type of smaller allocation of a portfolio.
Yeah, I just want to reflect on that, because if you're an early stage physician and you're listening to this, you probably shouldn't put too much into alternative investments until you've already maxed out your tax advantage, tax protected savings account. But there's a time in everybody's career where you're going to go along and say, I've maxed out my tax advantage savings accounts and I've got some real estate and I really do need to diversify a little bit more beyond what I've already put in my S&P 500 index fund or other tax advantaged accounts. And so some doctors, early stage, you're not going to really resonate with this, but there's a lot of people who are mid-career and beyond who say, I need to diversify, but I don't want to become a day trader. So I need someone to help walk me through this so I don't do something foolish with my money. And I don't know, you've worked with a lot of physicians. What are some of the common mistakes or some of the benefits? Doctors are notoriously bad with money, so they say. I guess I'm curious, what have you observed, not just from hearsay, but from your own personal experience? What are doctors good at? What are they bad at?
Yeah, so you're exactly right. They don't spend their careers learning about investing, right? They've got a lot of other time that they have to spend on their careers. And generally, they do a decent job of building wealth through their practice and also through just traditional investing. And then when you start to step into the other side of alternatives, the problem with a lot of them is that there's not much liquidity. So if you go invest into a private equity, private credit, venture capital, you're investing for 3, 5, 10 years. So if you put the money into that investment, you can't pull your money out because they're going to put that into this deal, this business, and these groups of companies that all use that money to operate the business or that investment. So what we found is that like a lot of the medical professionals is yes, they have some control over the account, but they have the liquidity whenever they want it. So they can deposit on Monday and withdraw on Wednesday if they wanted to. And that's a big, major difference of what our product offers and the majority of these alternative investments don't offer. And then just with like gold, if we were to look at gold's done really well over the last couple of years. We started this specific Midas strategy about 16 months ago. It started on February of 2025. And obviously we're now into June, but we ran the numbers through May. And so this is February of 2025 until May of 2026. Gold went up 51.31%. So that's pretty great for gold. An exceptional return there. And our strategy has done 517% over that same period of time. So it's a 10 times outperformance of gold over that period of time. And over that period of time, it actually had a lower drawdown, which means that if you had the peak, let's say at the peak of your account that you just bought and held gold in that account over that period of time, it went down by 26.81%. So if it was worth 100 grand at the very peak, it came down by 26%. And gold's actually having more of a negative month in June now. So it's probably even further down than that. But our strategy came down 26.4% over that period of time. So it actually had less volatility than gold, and it had a 10 times higher return. And the cool thing is, if you don't even want that much volatility, you can just turn it down in the portal. So you can say, you know what, instead of me being that aggressive, let me just tone the account down, and you could take 50% less risk if you wanted to, just by changing a number from 1.0 to 0.5. Now, what does that mean? That means that if the algorithm was programmed to take a $100 trade, now it's taking a $50 trade. So the volatility would be lower to the upside and the downside. So if the algorithm loses money, it loses half as much money. If it makes money, it makes half as much money as the default setting would be. So that's the cool thing, is it comes with default settings and it's set up on the default way. But if you wanted to be less aggressive and more conservative, you could do that, or you could be more aggressive than the default if you wanted to. So that's the cool thing about our platform and our strategy, is you're still in control of it and you can really determine how you want that algorithm to function. And then the last thing that I really didn't mention, I talked about a lot of the struggles with trading and the downsides, but the benefit of trading is something that provides market neutral exposure. So when you're investing, this is a different ballgame. You're looking for an asset, you're placing capital into an investment, and then you're waiting for that investment to appreciate. Now, if the new Fed chair Warsh starts to raise rates, just like Jerome Powell did in 2022, we could see gold go down, we could see real estate go down, we could see stocks go down. And all of those things, that's what happened in 2022 when we started to raise rates. Now, if you're in a trading based account, your money's sitting in cash. So that cash is not really going down. Yeah, inflation brings it down, it debases it a little bit. But what matters is that'll sit in cash, wait for an opportunity, enter the opportunity, and exit. So it provides something called market neutral exposure, which means that it's really neutral with no matter what the market's doing. If it's going up, down, or sideways, it still has the ability to make money. If you're just investing your money in general into the stock market, it's not market neutral because it fluctuates with what the market is doing. So if the market goes into a bear market for 2 years, your stock portfolio is probably going to go down for 2 years. Now, oftentimes it recovers as long as you're in good indexes and things. So that's not all around a bad thing, but at least you have a portion of your portfolio that is still has the ability to make money during that period of time. Does that make sense?
Yeah, it's all about diversification. Like you said, a total stock market index fund or an S&P 500 index fund, if I understand it, it's exposed to a really broad segment of the market. But if you do algorithmic trading, you can be exposed to maybe percentages of the market that you would not be if you're in the S&P 500 index, if I understand 100 really large companies. But it sounds like NURP, this Midas platform, would allow you to be exposed to other asset classes. So if I'm understanding, if there was a bear market, at least a percentage of whatever you have invested in that NURP account could be exposed to other areas that could grow when you're in a bear market for the top 500 companies. And so it just provides diversification. You can't really predict what the market's going to do, but it definitely seems like it's an alternative investment outside of your 401k, outside of your tax advantage savings accounts. But if you do it this way, there is an opportunity to have growth exposure to some of that money. So it's not just sitting in an account. If I restate that correctly?
Yeah. Yeah, exactly. It's uncorrelated. And it's not like you're placing the money in an investment and waiting for that to appreciate. It's sitting in cash and it waits for an opportunity, enters the opportunity, and exits. So it's often highly uncorrelated. It almost has a zero correlation coefficient to stocks, bonds, real estate. And that's why people like it so much.
Yeah, that's interesting. One of the things that on here is that I understand Midas has a phrase on here, a verified max drawdown of about 26%. So tell me a little bit about that. What does that mean?
Yeah, so that means that if the account went up, like I was saying, by, let's say the account was worth $100,000 and then it entered some trades that, let's say, was betting on gold going up. The account temporarily came down by 26% at one given time, and then it eventually recovered from that. So it's similar to like the S&P 500, right? During the tariff news of whatever, 2025, I think we had like a 18% drawdown or 15% drawdown, right? In the stock market. It's the same thing. That's what drawdown means, is what's your highest number? It's really like a high watermark. And whatever the high watermark is of your investment account, whatever percentage it comes down by from like a swing in the market is called drawdown. And the reason why it's verified is there's a third party called MyFXBook. They probably have a few million accounts connected to this. We don't own the company or have any affiliation. I don't even know who owns it, but they're a platform where you can connect an investment account and you give it your brokerage number and then you give it something called an investor password. What that does is it gives it view only access to all the transactions in that brokerage account. So it pulls all of the data from the brokerage account and then it shows you all the individual trades. So every single trade since inception of that account. And then it shows you that equity growth curve. It tells you what that max drawdown number was. It tells you what the growth was. It tells you what percentage of trades the strategy is winning or your account is winning. And it tells you all those things. So it's verified through that. And then we also sent the brokerage statements to another third party called Alpha Performance Verification Services that went through the brokerage statements and said that, yes, what's the data that's showing on MyFXBook does match up with what the brokerage statements are saying. So we got it double verified. And then all of our users can see it in the portal too. So they can see all the trades that are happening in the portal. And then they can obviously view their own account and see if the strategy is doing what the base strategy that's online in public for anyone to see. Oh, is my account doing the same thing? Yes, it is. Okay, great. So there's many different ways to verify that performance. And I think that's really important to have some transparency there. And then with your account too, you're going to be really following the Midas strategy. So you'll have that licensed into a demo account And you'll be able to see every trade that it takes over the next 90 days, which will be fun to watch and see how well or how poor it does over that period of time.
Yeah, I'm excited to try it. And I think maybe that's one of the questions I wanted to wrap up on is, so for someone like me who says, I'm really interested in learning more about this, I'm not quite ready to commit, I want to see how this actually works, I'm going to try it with this account that we're setting up. But what I want to know is, if for other people who are listening, other doctors who say, I want to learn more about this, I'm intrigued, but I'm not really willing to risk money until I learn more, where would you tell them to go? How can they learn more about seeing NURP in action?
Yeah, so there's a link in the description here. And what that allows you to do is go through a trial period. So there's like demo paper traded money, which is really just fake money. It's in an account, and you can license the strategy, and then you can watch your account, which is your demo account, and you can watch how that demo account performs over the next 30 days and see every trade that it's taking. You can see exactly where it enters, where it exits, if it made money, if it lost money. You can go take that account information, connect it to MyFXBook. You can see all the performance shown right in front of your face in the equity growth curve. Everything that we see and show online, you can also connect your own demo account to that and see that in a clear and concise way. And then again, watch all the back end trades actually happening live in front of you over at least a month's period of time. So yeah, there should be a link in the description here. And it'd be cool if some of your listeners also joined this demo, because what would be great is they join the demo, you're in the demo, and then we also have the live performance online, and we can watch all of them happening at the same time.
Yeah, I'm excited to try it out. Jeff, thanks for taking the time to educate us. It's compelling. It's interesting to learn more about different alternative investments. Appreciate you taking some of my hard questions and some of the questions that kind of helped us get educated as an audience, and I really appreciate that. So for everybody listening, I came into this a little bit skeptical because I think it's important to make sure we don't do things that are going to lead us to high risk, but I do think it's really important to become educated about this stuff. And what I hope is that we lead this discussion informed, not necessarily sold on it, but come and learn. Like Jeff said, try the algorithmic trading, try their demo. We'll put it in the show notes. But if you want to try it out along with me, I invite you to do so. And what I'm excited about also is, like you talked about, your capital stays in your account. You expose it to some market, but then it goes back and is basically untouched and still is in a cash account. Then you expose it to a trade, then it goes back to your cash account. And I think that's really interesting. It lets you verify what's actually happening, and it puts you in control of the decisions because you can decide what kind of risk you want to take. Same disclosure we talked about at the beginning. This is a sponsored episode. None of this is financial advice. But if this got you thinking, do the work, pull the verified numbers, read the fine print, ask the uncomfortable questions. Jeff's team set up a page for our audience. It's at start.nurp.com/doctors. Again, just that's start.nurp.com/doctors to see how it works with your money is staying there. So if this episode made you think, share it with a colleague who's trying to build a career that actually means something. And again, thank you, Jeff. I think our financial well-being is really important as we become doctors who are making a difference. And I really appreciate you taking the time. Thank you so much.
Yeah, absolutely. Thank you, Peter. I had fun.
Thanks for tuning into the Doctors Making a Difference podcast. And thank you for what you do to help your patients and your community. Your work truly helps so many people. We produce this content to help you have the tools you need to stay in medicine and to highlight the amazing work being done by physicians around the world. Please note that while I am a physician, and many of the guests on this program are also physicians or other professionals, the discussions on this podcast do not represent my employer or any professional organizations to which I belong. This podcast is for your information and entertainment only, and should not be taken as professional advice. You should seek appropriate professional advice pertaining to your own situation. Please check out more of our content on our website, doctorsmakingadifference.com. Also, please follow, like, or subscribe on your podcast player or YouTube channel, and give us a 5-star rating. It really helps to spread the message. Finally, if you'd like to be a guest on the podcast, or if you'd like to nominate someone else to be a guest, please visit the website or email admin@doctorsmakingadifference.com. See you next time.